Hi folks, and welcome back to Meaningful Money. Okay, it's just a joy to be back outside in the sunshine. It feels like it's been raining for about 3 weeks, but it's beautiful here now this evening. It's 7 o'clock on the 2nd of May 2012, so feeling beautiful. Just nice to be outside. I only managed to get one video up last week, and that was shot in my lounge. And it never just feels right somehow. Tried to shoot another couple this week, but the rain just kept me inside again, but the audio was shot on those, so I had to sort of abandon those. So it's great to be able to get outside and talk to the camera here in the bright sunshine once again. So I'm going to carry on our little series we introduced last time on successful investing and talk today about asset allocation. But as ever, before we get into the meat of that, my friends down here in the bottom right, 7 Investment Management, who continue to sponsor me here on Meaningful Money, for which I'm extremely grateful. Now, asset allocation is about how much of your money that you're going to invest, you put where. Now, I'll come back to that briefly in a minute, because do you remember last time we talked about three sort of factors, if you like, that you must keep in mind when you embark on an investment process. They are the return that you want out of the whole thing, how much money you want to make, the time scale you're working over, and then the risk you're prepared to take, the amount of money you're prepared to lose, or perhaps to put it a better way, the amount of fluctuation in the value of your money you're prepared to accept along the way. So the return you want, the time scale you're talking, and the risk you're prepared to take. These are going to keep coming up, okay? Particularly, I'm going to talk a little bit about sort of in raw theory terms today, and I'll come back then next time and apply that a little bit. So if asset allocation is the amount of your money you put where, if you imagine your money in your investment portfolio as a pie chart, it's how big each of the sort of slices of the pie are and where they are invested. Where they are invested, what do I mean by that? Well, you can invest in tons of different kinds of things. So you've got shares, obviously, most people understand that. Then you have things like gilts and fixed interests, corporate bonds, perhaps property. How about gold? Commodities like oil and gas or wheat. How about sort of infrastructure, private equity, hedge funds, currency, tons of different things you can invest in. Now, I actually looked at pretty much each one of those in turn way back in episodes 28 to 36. I reckon this is episode 207, so that really is a long time ago. So check those out if you want a bit more detail on what gold is and how it works and stuff like that. But suffice it to say, for the purposes of this, there's tons of things you can invest in, and there's tons of places you can invest in. So you can buy shares, not just in the UK, but you can buy American shares and European shares. You can buy property here in the UK or in America or in Vietnam or wherever. So there's not only tons of different kinds of things you can buy, but you can buy those things in many different parts of the world. Now, back in the early 90s, something called the Brinson Study was completed, and it was published in the Financial Analyst Journal. And what that did was it looked at a bunch of portfolios and it sought to identify what factors had affected the variance of returns of those portfolios. So how well or badly each of those portfolios had done. What were the things which affected the performance of those portfolios the most? Now, the results were pretty stark, actually, and perhaps they'd be surprising to you, because I wonder what you would say. You know, what would be the biggest contributing factor to the performance of a portfolio? Would it be, for example, the particular shares, say, that you chose? So choosing to invest in BP shares over, say, AstraZeneca shares, that would make a difference, surely. Well, it did make a difference, but they reckon only 5% of the variance of the portfolios, only 5% of that was contributed to by stock selection. How about market timing? A little bit of an itchy nose, hay fever kicking in, I think. What about market timing? You know, whether you got in at a good or a bad time. You'd think that would make a difference, wouldn't you? And it did, but the study reckons only 2% of the variance of these portfolios was down to market timing. There were some other factors which are fairly negligible, but a massive 91%, they reckon, of the performance of the portfolio was down to asset allocation. Now, that's fair to say that that's going to be fairly important then for you in your successful investing. Getting your asset allocation right is, pretty important. There's been other studies and the figures vary, but they all agree, pretty much, certainly the ones that I've seen, they all agree that asset allocation is vital that you get it right. And all that work builds on the sort of prior work in the 1950s by a guy called Harry Markowitz, who went on to earn a Nobel Prize. And he is the father of something called modern portfolio theory, which all this is based on. So I'm going to get into more detail about asset allocation next time, but for now there are two types. One is strategic asset allocation. It's your long-term view. Essentially, it's your neutral view. So if you had no opinion about what's going on in the world right now, that's your strategic asset allocation. Now the other one is tactical asset allocation, and that's your short-term view, because if you're running money, particularly if you're a fund manager running money for other people, then you're going to have a view about what's going on in the world. You're going to have an opinion about what's happening in Europe. You're going to have an opinion about the American election later on this year, the presidential election, and what that might affect things, how that might affect things. So your short-term view and the things you do with your portfolio to address those, that is your tactical asset allocation. So strategic is long-term view and neutral. Tactical is sort of short-term view, and you need both. Right? So I'm going to look at strategic asset allocation next time, though. So that's that for now. So thank you for watching. Great to be outside again. I feel at home. So thanks for watching, and I will see you next time.